salary sacrifice. We've had a range of questions from you in relation to salary sacrifice. Hopefully this next part of the session, and transition to retirement, hopefully this next part of the session will address all your questions there. Now, how does salary sacrifice work? Well, normally when your employer pays you, they firstly deduct some tax, so pay-as-you-go tax from your income, and then they, depending on how much you earn, it's a different rate. So it might be 21, 34.5, 39, or if you're in the top marginal bracket earning over $180,000 this financial year, you're paying 49% tax over that threshold. So your employer deducts that withholding tax from you, and then with the remaining amount, they generally put that into your bank account. Now you can go and spend that money, you can save that money, and you could put some money into your superannuation as well. You might do that to get access to the government co-contribution, for example, which is put $1,000 into your fund and the government gives you $500 if you're earning less than about $33,000 per annum. Now the alternative is, if you are salary sacrificing, what your employer does is before paying any tax, they're directing money directly from them to your superannuation account. Now the key thing here is that happens before any withholding tax is being paid. So the amount of withholding tax that we talked about up here is reduced, and that's the key benefit. So you do pay some contributions tax. So if you look at when you do put money into super as a salary sacrifice contribution, there are contributions tax payable here. But the key thing about salary sacrifice is that the contributions tax is less than, so it's generally 15%, or if you have an income over $300,000, the contributions tax is 30%. Now the key benefit here is that you'll pay less pay-as-you-go tax because you're reducing your income by putting money into super, and you're paying less pay-as-you-go tax. The remaining amount that your employer has left over, it will go into your bank account, so you'll be getting less into your bank account, but overall, because you're paying less tax, you're often better off. The money that goes into your bank account, you can still spend that, you can still save it, but the key thing to remember about salary sacrificing to superannuation is the benefit is the difference between your marginal tax rate, whether that be 21%, 34.5%, 39 and 4 or 49, is the difference between your pay-as-you-go marginal tax rate and the contributions tax rate, depending on what your earnings are. If we leave off those earning over $300,000, then the benefit here is the difference between 15% and 21%. So you've got a benefit there of what, 6%? So if you were salary sacrificing $10,000, 6% of that is going to be what, $600, is it? If you're on the 34% tax bracket, so you're earning between $37,000 and $80,000, then the difference here on $10,000 is going to be 19.5%, or on a $10,000 being salary sacrificed, $19,500. If you're earning over $80,000, then the benefit or the difference between the contributions tax rate of 15% and your marginal tax rate is going to be 24%. So on $10,000 salary sacrifice, you're going to save $2,400 per annum. Now, so depending on your tax rate, you're going to have potential savings, on $10,000 of $2,400 to $600, or between those thresholds. If you're on 49% tax bracket, earning over $180,000, then the amount that you salary sacrifice, 15%, so at 34%, or $3,400. Hopefully I'm doing my sums on the fly. I'm terrible when I do them on the fly. Assuming that you're earning less than that $300,000 mark. So you can see this is the tax saving on salary sacrificing into super rather than taking your income in your hand.